Let's get you on board. Kunal Bothra, he's joining us live from the studios. And let's go across to him to find out which interesting topic he's going to be teaching us today. So Kunal, over to you.
Srishti, good morning. Shil, good morning to you as well as to all the viewers. And today's topic is very classical because we all find a question that how do you ride stocks which are trending up high and how do you ride and eventually these stocks become multi-baggers as such. So one of the simplest methods to do is to use the 200-day moving average on individual stocks and then trying to bifurcate or identify which are the stocks which are extremely strong, which are the ones which are extremely weak, and do you want to average the weaker stocks or do you want to average the stronger names. So I've taken classical examples over here. The first example of 200-day moving average and how to ride the trends for stock prices is on Abbott India. This is the charts over the last 8 to 9 months for the stock. And we've seen classically that Abbott India, when the stock crosses about the 200-day moving average, the trends sustain for a longer period of time. And the more the stock is above the long-term averages, the more is the probability that the stock would continue its uptrend even after a phase of a pause for itself. So look at the last 8-9 months of charts for Abbott India from a point where the stock was almost at 18,500, end of 2022. It gradually moved into that upward trend trajectory move, and the stock is now perched at 24,500 mark. This gives you a classical concept of how the long-term averages. This is the 200-day moving average, the red line which you can see, and the stock in the process of the last 8 or 9 months of the subtrend has not broken even once below the long-term average. But on the other hand, which are the stocks which we should ideally avoid when you're looking to buy the stock or looking to time the stock? This is one example like this for Aarti Industries stock where we receive a lot of queries. Look at the last 8-9 months of charts, a very similar kind of a time frame, but the stock has been consistently trading below the long-term averages, and these are the kind of stocks which you should ideally avoid because this indicates that the long-term trend for the stock is still on the negative side. You may hold on to the stock, may not look to average, but then averaging out should be done only once the stock crosses back above the 200-day moving average. And one of the classical stocks which has done exceptionally well, the entire sector which has done exceptionally well, something like HAL, the stock which was almost at 500 rupees end of 2020, start of 2021, has yet not broken below the 200-day moving average. And you've seen how the stock has multiplied from 500, the stock is now almost at 4,000 rupees. So that's a classical sign of how do you identify the importance of 200-day moving average and ride the winners and don't put your money on the losers.
Right, that's the way how you can ride the winners by actually taking note of what's the importance of the 200 DMA. And actually that's been a question in a lot of viewers' mind, especially in-house as well. Even our producer Abhishek also was very interested to understand what's the importance of 200 DMA. And thank you so much, Kunal, for explaining that to our producer as well as all of our viewers.